Alright guys, so real quick I wanted to make this video because I'm so excited to finally get into what I do and how I can help you guys learn how to actually invest into the stock market the right way. I know a lot of people assume that it's all about buying low and selling high, and while that is true, guess what? There's also some strategies that I like to use that are guaranteed income in such a way that I can predict my probabilities of being correct. And in this lesson, in this presentation, you're actually going to see how you can make the stock market work for you and not against you in such a way. Another thing that I'm going to teach you is hopefully get you out of that trader's mindset. I still got guys coming to me and they still say they want to trade penny stocks or they want to trade stocks altogether. This is going to show you somewhat how you go to a casino and the odds are always against you, because guess what? The casino is a multi-billion-dollar business. The odds are always stacked against you. Another thing that I want to show you in this is before you even buy a stock, you should be put selling. And you're probably like, well, what's puts? Okay, they are stock options or derivatives of stocks. There's also options in the SPY that I also recommend you looking into, and I'll get into that. But for this first slide, obviously, I'm going to cover the put selling strategy ideas for you, and this is found what I do at investingwithchris.com. So Amazon, we'll look at Amazon in this study and the strategies that I use to selling naked puts versus verticals. Naked puts are primarily for larger accounts, but they're also good for people who want to get into a stock but not right away. So instead of just rushing out and buying a stock, you can actually sell puts until that price is more favorable for you to get in, so you're actually collecting premium or cash flow until you're ready to buy that stock, or that stock price comes down to that point that you're ready to buy it at. So naked puts are primarily for large accounts, and that's specifically for Amazon in this case. Vertical spreads work more for the smaller accounts, $2,500, $5,000, even $25,000 accounts. Terms. Okay, so what is a short naked put? Short naked put is a bullish strategy that is executed by simply selling a put option. This strategy typically needs a larger account depending on the stock's price. Overall, it's used to capture cash flow while being interested in obtaining at least 100 shares of stock that one might be interested in. Now, that 100 shares acts because stock options are one contract and theoretically they're 100 shares worth. Okay, so the stock is only assigned if the strike price shorted is at the money by the time expiration comes around. Short put vertical spread. A short put vertical spread is a bullish defined risk strategy made up of a long and a short put at different strikes in the same expiration. This defined risk not only helps smaller accounts but also allows them to know their maximum profit or loss. In a naked put, you actually know your maximum profit too, because you're shorting that and you're getting that premium right away. But in this case, this helps hedge into a position because you're shorting and immediately you're buying right back, so you're defining that risk. So the naked put example. Now I'm using Thinkorswim, and I also timestamp this for you guys so you can go back into your system, and I'll show you how to do this at February 2019 at 12:20 and 17 seconds. Okay, the put option was priced just right for this example, and Amazon at the time was 16.30. Okay, so the naked put, if Amazon is trading at 16.30 and John is not willing to buy Amazon quite yet at 16.30, but he is wanting or willing to buy 100 shares at around 15.45. While John waits for the price of Amazon to come down, he can capture premium in the meantime until the price reaches that 15.45 price, where he then would be assigned the 100 shares plus the premium collected, or you can take that away. So that's your break-even point. I'll explain that down below. So you're collecting the premium, and then if the stock actually drops to that price, you're also assigned that 100 shares or however many contracts if you have on. If you have one contract, you only get assigned 100 shares of Amazon. If you have two contracts, 200, 300, and so on. Another example of this type of strategy could be similar to the car insurance companies collecting premium until they have to pay for a totaled car and obtain that vehicle. So let's say you go out and crash your car. In the meantime, before you even was to crash your vehicle, you pay insurance companies saying if something happens, they'll pay you, okay? So would you rather be the person buying car insurance, or would you rather be the insurance company? Car insurance companies and insurance companies make bank because people just like you that are not familiar with these types of strategies are always buying things, okay? So let that be a lesson. You can actually sell before you even was to buy, and that's within the stock options. I wouldn't recommend shorting stocks themselves because there's unlimited risk at the high level. If you was to short a stock and it was or to go up, then you're going to be losing your portfolio. But in stock options, it's a little bit different. You actually get assigned an asset, and then there's also strategies where you can start making money on the flip side of that. But for this case, in this example, we're only dealing with the put side. So the probability of expiring out of the money is 70%. That's usually the probability of success that I like to go down to, and I'll explain that here in a second. But in this case, its probability of out of the money is going to be 70%. So you have a 30% risk, but 70% chance of actually winning and making at least $1. I'm going to say that. Okay, so the premium collected on this move is $2,100 or $2,165 for the March 22nd, 2019. Would expire in 36 days from the date of February 14th. The current implied volatility is 31%. Now, most of the time, we want to sell stock options when implied volatility is at its highest, or historical volatility shows that IV is about that same price or that same percentile. So this is really not the best example, but I am giving you an example of how I've been doing Amazon lately and making money off Amazon without even owning, $160,000 worth of shares. I literally am using stock options. So the current IV is 31%. We take the 1545 times 100 minus the 2165, which is the premium collected. That would be the cost of capital if assigned, would be the $152,335. Now, as you can see, that's why this naked put is for larger accounts, because normal, or don't want to say normal, for the average investor who's just starting out, they probably don't have that type of cash or the capital to put up. And also my rules is, you don't use no more than 10% of your entire portfolio on each strategy. So that would clearly be around $1 million portfolio for this to work. Or if you have a lot of risk and you don't even care about losing your investment, you could put up that risk. But this is just for this example. So the break even now would be the 1523 at 35. So we're worst case scenario, we get assigned the 100 shares at the 1545. We would have to throw up then 152,335 for the fact being we've already collected 2,165. Okay, so the investment gain is the 2165. The ROI is a 1.42, and the annualized return on investment is 15%. Okay, in real estate and all these other people that's promoting real estate, good for you. I'm glad. Like, that real estate is not bad investments at all. It's easy cash flow for anybody, and anybody should start investing. But as you can see, annualized return on investment just on this one strategy is already at 15%. But as an individual investor, 15% is pretty high. So just keep that in mind. So that's the naked put example. And real quick, this is what it looks like in this Thinkorswim platform. And so I'm going to drop down into my Thinkorswim platform to show you guys how to set up this and give you a little visual actually about the platform. So once we're in Thinkorswim here, we can see that we have a whole bunch of buttons, tabs, and everything. And for the sole purpose of this video, you'll go into the tab, trade, and we'll drop down to the options chain. Now, this is all of the stock option time frames that we can invest within: 22 days, 15 days, 36, 43, and on out. Now, the key, and I'll show you this why in another slide. The key is no more than 63 for these types of strategies, or more than 60, specifically 30 or less. So right at the 35 days till expiration is prime. So we place this trade, as you can see, in a 36, and we'll scroll down to the 1545. Okay, we can see that the implied volatility 31%, and right here is the bid and ask. Okay, these are the bid and ask prices for the stocks. Right here we can see the stock price itself is $16.30.97. But for the sake of the stock options, they're priced a little bit different, and they'll be in another lesson how they're priced and all that. But these right now in the black are out of the money for the puts. Puts are on the right side, calls are on the left. These are in the money because we know that the stock price is at $16.30, so all of these are already in the money for the put side. For the call side, these are out of the money and these are in the money. So we'll scroll up to 1545 and we see that it's 2165 on the sell side and the buy side is 2255. So we'll click on this and we'll bring the order information up, and if we can limit our orders, you know, we can define how much we want to take in, but I quickly just done the natural, which is right here. That means it will get filled at that price because that's what it's at right now. So I want to show you something. You'll hit confirm and send, and this is where we'll get the 2165 premium. That is taken in right away. The 152.35, it says max loss, but you're actually gaining an asset. You're gaining 100 shares of Amazon. Now, in the previous lessons, which I know that was dry, I went into the finances, how to read an income statement, not a cash flow, we haven't hit that yet, but a balance sheet, and how to define your margin of safety within companies and to figure out whether or not they're going to be good investments. Well, we know that Amazon's pretty good stock right now, and it's a good investment. We wanted to say that, well, worst case scenario, John wanted to pick it up at the 1545 mark, so that's why we're trading this. Another thing that I want to explain is that the deltas, I'll get into the Greeks in another lesson, but for this case, delta is really the probability of being in the money. So we know that this is working in our favor because it's at a 25%. So that means, alternatively, we know that we're going to win 75% chance, or 75% of the time. So that's a really good investment. We've got 36 days within the curvature. The theta, which is time decay, will start working on our side, and I'll explain time decay later. If you've got any questions, just drop them in the comments. If this is on YouTube, Facebook, or wherever, feel free to jump on the website of mine and email me, and I'll take your emails in and I'll answer any questions. So we can see that how we pick up 2165, and I'll actually do this. I'll go ahead and hit send. You'll hear so it was assigned to me for $21.95. So my net lick will go up because that premium is automatically collected within a click of a button. So that, as you can see, was screenshot from there. Okay, so we're going on to the next slide. This, the analysis of what this actually looks like. So at the expiration, we can see our point right here at the 1545. Or right here, if the stock was to drop below that price that we shorted it at. Anything right here is our profit. And as you can see, we've defined our profit. We can't gain any more than the 2165. However, we can lose, and that's only if the stock was to get assigned to us and then it was to continue to plummet. There's also strategies that I'll show you later on where you can actually make money on the flip side if the stock goes in the opposite direction that you don't want it to once you have it assigned to you, or if you own shares. So for the short put vertical spread, we'll say that's for smaller accounts, because as you can see that the previous example, you would at least need $150,000 to cover that if assigned. So using a credit spread, we can short one strike price and immediately buy back a put option at another lower strike price, defining our profit and loss. The defined risk is a difference of strikes minus the credit received. So if that doesn't make sense, so let's take the same strike, 1545, that we shorted it with, and immediately buy back the 1540 strike. So that would be a $500 difference. And why I say 500, because it's 5 difference, 1545 to 1540, but we have to times 100 because everything, one option contract is 100. So the defined risk with possible max loss is 435 because we're actually picking up $65 worth of credit minus the difference in the strike prices of the 500. So that is our total loss of 435. Same probability of success is 70%. Premium collected is the $65 36 days to expiration, and a max loss at 435, risking to make 15% with less cost of capital, but will not have shares or assets to hold. Guys, if I knew that I could make 15% back in my 20s by literally setting up a TD Ameritrade account and start investing and compound that 15% over the next 15 years, guys, the power of this small investments but constant over and over again, you can imagine what your portfolio would look like. And that's why I'm trying to educate you guys and to get you into investing at an early stage. Now is better. If you're my age and I'm just now getting to you and this is all, I'm grabbing your attention, then great. That's the key. Start now. It's never too late, but at the same time, the earlier you begin, the more you'll come out with in the long run. So imagine if you only had $2,500 to invest with, you are only using 18% of your entire portfolio to make 15% returns every 36 days. Now remember, my golden rule is 10% of your entire portfolio on each strategy, but this is pushing it. It's a little bit more safer. It is a credit spread, and credit spreads, you're defining your risk. You're basically locking in profits, and you're locking in max loss, where you're shorting and then you're immediately buying one in return. So let me show you that real quick. I'm going to finish these slides in the first case. And as you can see, the break even, this system shows you your break even. That way you can start managing your strategies for the next investment, or managing your risk, however you want to do that. It shows you your break evens, your losses and your profits, and also the cost of those trades. So why THETA is on our side? As you can see, that when you sell options, THETA works for you because time decay. And what time decay means is that the curvature or that time frame that everything starts coming down with you, that option, it expires out of the money. So the time decay, for every day that passes, that option is getting less and less, less and less to buy back. Or let's say this, if you was to buy a put option, that it actually gets less and less valuable the longer away that stock price is, or that strike price, and it's not reaching the strike to which you had bought it for, or to sell back. So THETA is on our side. So THETA measures the rate at which options lose their value, specifically the time value, as the expiration date draws near. This is why selling options is better for investors than buying options. Time is on our side. Just like the casino, we have the odds stacked against buyers. So the 30 to 45 day to expiration time frame is the key. And as you can see, THETA right here, these mean it loses about 51 cents times 100, $51 a day. And as you can see, the time decay curvature is shown right here. Anything from 90, it's not really losing value, and then right here is where it really starts kicking in, the 30 days, 45, 30 days, and then all the way down. So within that last week, stock options really lose a lot of value. So the goal is to pick it up when it's high implied volatility, or when it's at a high price, and then you can also close out your positions at a much lower price by buying one back, or just leaving it expire if it's out of the money still. And then guess what? You collect that premium, no shares are assigned to you, and you walk away, and you do that over and over again, compounding your profits, making cash flow. So I hope this helps. I'm going to show you how to actually close out or buy back a put option to make that credit spread. So let's go over to the Thinkorswim platform again. And looking at the 1545, and we stated that we're automatically or immediately going to buy back the 1540. So we'll hold down our control button over the sell side, which is the bid, and we'll collect that 2165. We'll go up to the 1540, and we'll also, while holding the control button down, we'll click on buy. And as you can see, that gives us $1.22 really. However, you're not going to collect that. If you're lucky, yes, you can set it in, walk away, and if the price happens to fluctuate closer to these two prices, you could get locked in at 122. But if you wanted to say you wanted to go ahead and collect it right now, that's where this 65 comes in at the natural price. Hit confirm and send, and guess what? I've just been locked in, and it actually says 122, but that's because I got it on pause on my on-demand feature here. but it gets locked in at 65. In this case, it actually gave me $1.22. But in live time and live feed, you'll get locked in at 65 cents, which again, 65 times 100 is 65 cents times 100 is $65. So just remember that. Stock options work. One stock option contract is theoretically 100 shares. Before you was to ever buy a stock and you're interested in that stock, don't immediately buy it back or buy it at that price. Start working your premiums in at 70 or your deltas of 30s or 20s, and get some cash flow coming in until you're ready to buy that or it drops down that price. Because I learned from my mistakes. I immediately, when I first got into investing, I'd rush out, buy a stock, and I didn't know this cool feature that you can do this. You can short a put option, make some cash. If the stock goes down that price, then it's the best of both worlds. So anyways, I hope this helps. And if there's anything that I need to cover more or that to do better, please reach out. And if there's any questions, again, please reach out. So that's it for now. I'll see you in the next video.